Hey everyone, welcome back to Corporate Decoder, the place where we unpack the complex world of business filings, and tonight we're diving deep into eGain Corporation's latest quarterly report. Will see if their AI customer experience solutions are really paying off or if there is more to it than meets the eye. So eGain is all about using artificial intelligence to help companies talk to their customers better and faster. Think of it like a super smart assistant that knows all the answers to customer questions. Instantly a knowledge hub powered by AI, this quarter's report for December 2025 gives us a snapshot of how that mission is playing out financially. Let's start by looking at their financial health. On one hand, their total assets have seen a slight dip. As of the 31st of December 2025, they had about $146.8 million in assets compared to $148 million back in June 2025. This is a small drop, not a huge alarm bell, but it means they might have fewer resources to play with at the moment. On the other hand, their total current liabilities are also down from about $62.1 million in June 2025 to $52.8 million by December 2025. That is good news, meaning they owe less money in the short term, making them a bit more stable. Their additional paid-in capital is steadily climbing from $411.2 million in June 2025 to $416.3 million in December 2025. This usually means they are bringing in more money from selling stock or other equity-related activities, which is a sign of investor confidence. Now let us talk about the money they are actually making the revenue. For the 3 months ending the 31st of December 2025, their total revenue was just under $23 million. This is a slight increase from about $22.4 million in the same period last year, so sales are growing but slowly. The bulk of this comes from SaaS revenue, which is their subscription-based cloud service. This SaaS revenue climbed by about 5% for the quarter and 7% for the 6-month period compared to last year. This shows their core business is growing, which is great for a tech company. However, their professional services revenue, which includes things like consulting and implementation, took a hit. It dropped by about 23% for the quarter and a hefty 21% for the 6-month period. This could mean clients are doing more of the setup themselves, or that the company is focusing less on these services, perhaps to boost profit margins. Interestingly, their cost of revenue, that is the direct cost associated with delivering their services, actually went down by about 8%. This is a positive sign, as it means they are becoming more efficient in delivering their SaaS and services. This efficiency led to a better gross profit margin, a jump from 70% last year to 73% this year for the quarter, and 74% for the first 6 months of the year, up from 69%. This means for every dollar of revenue they earn, they are keeping more of it after direct costs, which is a very solid improvement. On the expense side of things, research and development costs dipped slightly. They spent about $7.3 million on R&D this quarter, down from $7.7 million last year. For a tech company investing in the future, this dip might be something to watch. Are they slowing down innovation or just becoming more efficient with their R&D spending? Sales and marketing expenses also saw a small decrease. It came in at about $5.2 million this quarter, down from $5.25 million last year. While this might seem good on the surface in a competitive market, a slight decrease in sales and marketing can sometimes suggest less aggressive customer acquisition efforts. Now, general and administrative expenses, which include things like legal and management costs, saw a notable jump up by about 10% for the quarter and a significant 28% increase for the 6-month period. A big part of that 6-month increase was related to warrant expenses, a financial instrument that can be complex. This rise in GHEA is worth keeping an eye on. Despite the increases in some expenses, their improved gross profit really helped their operating income. For the quarter, it jumped from $650,000 last year to $2 million this year, an increase of over 200%. That is a massive improvement and shows their focus on efficiency is paying off. For the first 6 months of the year, operating income also climbed significantly. Their income tax provision also saw a significant increase, meaning they are paying more in taxes, which is usually a good sign as it indicates higher profits. And the bottom line net income more than tripled for the quarter, an impressive rise. For the first 6 months of the year, net income also saw a substantial increase, showing the company is becoming more profitable. Looking at cash flows, the company generated more cash from its day-to-day operations this year compared to last year. This is a strong indicator of financial health, as it means the core business is producing cash that can be used for investments or to pay down debt. Now let us talk about the worries, the risks. eGain operates in a super competitive market. They mention companies like Genius's Lufperson and even tech giants like Microsoft and Salesforce as competitors. The AI space especially is heating up and competition is fierce and fast. If they don't keep innovating and staying ahead, they could lose ground. One of their biggest headaches is their long sales cycle. It can take months, sometimes over 6 months, to close a deal. This makes it really hard to predict revenue quarter by quarter, leading to shaky financial performance. They also rely on a few big customers accounting for a large chunk of their revenue. Losing even one of these giants could seriously hurt their finances. This high customer concentration is always a big risk. Then there is cybersecurity. In today's world, this is a constant worry for any tech company. A breach could mean losing customer trust, legal woes, and massive financial costs. eGain acknowledges these risks and its importance in keeping customer confidence. So what is the big picture here? eGain is showing signs of improvement and efficiency. Their SaaS revenue is growing, their costs are being managed well, leading to much better profitability and cash flow. They are making more money for every dollar they earn. However, the company is not without its challenges. Long sales cycles, reliance on a few big clients, and intense competition in the AI market are significant hurdles. The increase in general and administrative expenses needs careful watching to ensure it does not eat into their profitability. In essence, eGain seems to be tightening its belt and focusing on delivering its core SaaS product more efficiently. The company is headed in the right direction regarding profitability, but it needs to carefully navigate the competitive landscape and manage its sales process more smoothly to truly accelerate its growth. Alright, that is our breakdown of eGain Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content and discussions. Thanks for watching. See you next time.